Welcome to the Stock Next Education Program. Let's explore today's topic. The Australian federal budget for 2026 has introduced major changes to capital gains tax, also known as CGT, and the changes could reshape how Australians invest their money in the future. For many years, investors who held assets like shares or investment properties for more than 12 months received a flat 50% CGT discount. That meant only half of their profit was taxed when they sold the asset. For example, if someone bought shares for $100,000 and later sold them for $200,000, the profit would be $100,000. Under the old rules, only $50,000 of that gain would be taxed. The same rule applied to investment properties. But under the new budget proposal, the government plans to replace the flat 50% discount with a system linked to inflation. Instead of automatically cutting the gain in half, the new method will adjust the profit based on inflation first, and then apply tax mainly to the real gain, the actual increase in value above inflation. The government says this change is designed to make the tax system fairer and reduce the strong tax advantages that encouraged investors to buy existing properties. Treasurer Jim Chalmers said the current system has pushed too many investors into the housing market, driving prices higher and making it harder for younger Australians to buy a home. The budget also revealed that inflation made up a large portion of long-term share market growth. Over the past decade, inflation accounted for more than half of the growth in major Australian share indexes, like the ASX 200 and the All Ordinaries. By comparison, inflation made up a smaller portion of property price growth. This means share investors were often paying tax on gains that were heavily influenced by inflation, while property investors benefited more from the generous 50% discount. Economists believe these new rules could encourage Australians to diversify their investments away from existing properties and into shares, businesses, or new housing developments. Here's a simple comparison. Under the old system, a property investor who made a $300,000 profit could reduce the taxable amount to $150,000 immediately through the 50% discount. Under the new system, if inflation accounted for part of that growth, only the real profit above inflation would be taxed, changing how investment returns are calculated. These reforms could become one of the biggest investment tax changes Australia has seen in decades, potentially shifting investor focus from property to shares and other forms of wealth creation. That's the Stock Next educational program. Thanks for watching and see you next.